Good morning, everyone. Welcome to the U.S. Center. Thank you. This event is Institutional Investors, Finance Partners for Climate Infrastructure. And now, let's welcome to the stage our lovely panelists. And now I'd like to welcome to the podium Alexia LaTortue, Assistant Secretary for International Trade and Development at the U.S. Treasury. Give them a warm round of applause.
Thank you so much. Good morning, everyone. It's great to see you. I'm really excited about this panel, and you may all please sit down. I'm really excited about this particular event because I think it's the perfect mix of actionable actionable ambition and radical collaboration that everybody is talking about at COP that is so needed on one of the most talked about topics of COP, which is mobilizing finance. Of course, we need all sources of finance to meet our climate and development goals, domestic resource mobilization, private philanthropy. But today we will focus very specifically on mobilizing private finance, and actually even more specifically on mobilizing finance from institutional investors and from pension funds in specific. So we know that pension funds have tens of trillions of dollars in assets worldwide, and shifting even a small percentage of that could unlock billions of dollars for our climate and development goals. However, pension funds, of course, have a responsibility to protect the savings of hardworking middle-class people, firefighters, teachers, and so they need to invest sensibly. At the same time, we know that there's an increasing interest among those pension funds, particularly in the climate space, the clean energy space, and increasingly in emerging markets as well. And so after getting together about half a dozen practitioners in a beautiful setting in Bellagio, Italy, we had a bit of a discussion with the people here represented on this panel around what could we do to specifically move the needle on attracting pension fund investing into this space. And so I'm really delighted that we have represented here today Director Eno Ebong of the USTDA. We have also with us the CEO of the Secretariat of the Investors Leadership Network. And together, hosted by Rockefeller Foundation, and we have Eric Pawlowski represented here, we identified 3 areas where we wanted to make tangible progress on. The first one was how to build that pipeline of investment-ready projects. The second was how to improve the availability of data around real investment opportunities in emerging markets. And then the third area was to identify and to increase awareness around the range of de-risking tools that multilateral development banks and development finance institutions have. So that is the work that came out of Bellagio. This partnership between the institutions that I just mentioned really has emerging markets in mind. And so what does this partnership mean for developing countries, many of which are really bearing the brunt of the climate change? First of all, it could mean more high-quality projects that increase citizens' ability to access clean water, to have access to renewable electricity, to have good jobs. For governments, it could mean not having to go to public coffers to be able to make investments, for example, in energy grids or in solar projects. And then for local businesses, it means having reliable telecommunications, or it means having the right transportation to get goods to markets. So what we are discussing today is about impact for real people, real businesses in real countries, and that's what motivates everybody on this stage. With that, I'd like to invite Director Eno Ebong for opening remarks.
Thank you so much, Alexia, and good morning to all of you. I am so delighted to be here, and I think Alexia has really elevated some of the words that give me this sense of great excitement. It is action, it is radical collaboration, and it is impact on communities and on people. And we really have had a great ability to come together, institutional investors, the U.S. government, to make this happen. So just a little bit about the U.S. Trade and Development Agency, which is the government agency that I lead. It is the U.S. government's overseas project preparation agency. And we work in emerging economies, developing and middle-income countries to mobilize capital into infrastructure development projects. So we provide grant-based fundings for feasibility studies, technical assistance, pilot projects, the very kinds of activities that will open up projects to investment. Our role is truly catalytic, and it really serves to prepare projects so that they're technologically well-defined and so that they can be financed. Just to give two quick examples so that you can crystallize it. Several years ago in Vietnam, we supported the development of a 75-megawatt offshore wind plant. It came online in October of 21. It is powering 180,000 homes and has the ability to cause 60,000 metric tons of reduction or avoidance of greenhouse gases per year. Similarly, in the Philippines, a little bit larger in scale, working to provide, again, offshore wind energy off the islands of Mindanao to the degree of 3 gigawatts. This project has already caught the attention of the Southeast Asia Climate Energy Facility, which is focused on providing early capital to infrastructure development projects. So that's a little bit of USTDA. We came together in Bellagio, Italy, supported by the Rockefeller Foundation, to really look at how we can mobilize capital. And we had, as Alexia said, key discussions, identified several areas of attention, one of them being the need for bankable projects that investors can finance in. So the strategic agreement that we are going to enter in today actionably does that. USTDA will bring its expertise in project preparation to provide a pipeline of projects that the members of ILN can consider for debt or equity financing. In the end, the focus of the partnership will be to mobilize capital for projects that have capable, experienced project sponsors, that have a strong potential for commercial viability, have strong potential for large-scale developmental impacts that our U.S. private sector can have an interest in deploying technology to, and that has host country support. These are all of the elements that are necessary for successful implementation of infrastructure development projects. So the ingredients are there, the will is there, the desire for action and result is there. And so we are very grateful to have the opportunity to highlight it and sign the agreement momentarily. Thank you so very much. I would now like to turn over the podium to Amy Hepburn, the CEO of ILN.
Thank you so much, Assistant Secretary Latortio, Director Ibong. I really appreciate and want to echo the excitement and praise for all of the hard work that has gone into getting us here today. The Investor Leadership Network, a legacy of the 2018 G7 and representing 14 of the largest global institutional investors, overseeing assets over 10 trillion, understands that there is no such thing as living in a private sector world or a public sector world. We know that our one healthy, sustainable, and prosperous future will be built together, and it will be built together through partnership. And not just any partnership, but a partnership that is deeply collaborative, a partnership that is thoughtful, and a partnership that is judged by decisive action and meaningful, measurable impact. And that's the partnerships we're talking about today, and I'm very grateful to be here with you. At ILN, our strength lies not just in our numbers, but I'm proud to say it lies in our shared vision. And it is a vision that transcends borders and individual interests in favor of a sustainable, thriving global economy. In June of 2023, as you've heard, the Investor Leadership Network, spearheaded by the leadership of CDPQ, Marc-Andre on the stage here, Natixis Investment Managers, and 91, represented by NAS, stood alongside United States Secretary Janet Yellen and set forth a new commitment to work in partnership to accelerate pension fund and institutional investments in emerging and developing economies. Supported by U.S. Treasury, the Rockefeller Foundation, Eric, thank you, the leadership of CDPQ, Natixis, 91, and our members, we are uniting our forces to increase access to data, develop mechanisms that will streamline investment into these key sectors and countries while honoring our respective mandates and role as fiduciaries. As we move forward, it is my pleasure to officially announce the launch of a dedicated private capital mobilization consortium, nicknamed our Bellagio Consortium, from where we originally met and formed these relationships, to become a catalyst for action. And this catalyst for action will propel us forward in achieving our goals towards the measurable impact that defines meaningful partnership. Specifically, our consortium has 3 objectives. The first, to convene institutional investors, public sector actors, and philanthropic donors to foster collaboration that increases private capital investment for climate-related objectives, particularly in middle-income emerging markets. The second is to drive impact through defined activities and innovative new structures of public-private partnerships, the first example of which is being announced today through our partnership with USTDA. We're really part of that and thank everyone on the team who made it happen. And the third is to influence key decision makers across all of our sectors, public and private, for lasting change, so that we are held accountable for what we say we are going to do in terms of being both impactful and sustainable in the enabling environment to the future we are looking to build together. Together, those of us on the stage, I know I speak for all of us, we are looking to steer investments towards a future where economic growth aligns seamlessly with environmental stewardship and social progress. So thank you so much for being here today. I thank all of my collaborators here on this stage as we continue this journey towards the consortium's development and success.
Thank you so very much, Enno. Thank you so much, Amy. I would now like to have a bit of a discussion with the rest of the panel. And I'd like to start with you, Marc-Andre Blanchard. You're the Executive Vice President and Global Head of Sustainability at CDPQ. CDPQ is the second largest pension fund in Canada, so a very important player in this field. And I would say, Marc-Andre, you have been a leader in the space of sustainable investing, and I really thank you for that vision, leadership, and partnership. And so my question to you, Marc-Andre, is what kinds of actions do you believe institutional investors can take to increase investments in emerging markets, while of course also abiding by their fiduciary responsibilities?
Well, thank you very much. Thank you, Alexa, and thank you, Enno, and thanks, Amy, for this is a great outcome. And now the work begins. The work begins for all of us. It is a journey that institutional investors are on. Some of us, like CDPQ, we have already approximately $60 billion of assets in emerging markets. But we have them in countries like Brazil and India, larger countries. We have bought into this idea, this ambition of being really strong in renewables and playing a big role in the transition. Now to go further, to go in places where we don't go, to do things in the transition that we don't do. There's a few things we need to do internally, and but your word, I know, about the radical collaboration is it sounds cliche, but it's so needed for this, because internally we look at a lot of investments. We look at our investments through a lot of about obviously the risk-return equation, and part of that is the ESG analysis. And we look a lot about it, obviously, and it's needed that we need to look at our investments and look at the risks of our investment. But we also now need to push the envelope a little bit on the opportunity side. And this is a mindset that needs to be slightly different. And to be able to do that, I actually believe we need to be better at when you don't know something, you tend to overestimate the risk and underestimate the opportunities. So that's an issue that is often the case at an institutional investors like CDPQ and our peers. So we need to be better. That's why the radical collaboration comes in, because we need to expose ourselves to more partnerships like the one we're creating. We need to expose look, just think this week, Brookfield and Luneti have announced this partnership for investment in infrastructure. We with Temasek have expressed an initial interest in joining them, and we're going to continue to do the work. But that will bring us into places and in thematics where we've not been before. That's the reason why we joined this thing. And if it would have not have been because of the leadership of Luneti and also of Brookfield, then we that would not have been pushed forward and all of that. So we need to seize opportunities like that. But it's a bit, for us, it's different, and it's uncharted territory. So we need to accept to do that, and but there's no one size fits all. Every one of our peers has a different personality and different approach to market. Some will like to go with funds. Some will like to go direct. Some will need to do specific funds within their institution. Some will actually probably need to put it in the compensation. We put a carbon footprint in our compensation. Then maybe someday we will need to actually add to these criteria. So it's not one size fits all. It's not one magic bullet. It's many things, but it starts with radical collaboration, and it starts with an openness to actually go outside a little bit of our comfort zone of where we invest in the thematics in which we invest normally. And we need to recognize, I'll finish on that, institutional investors clearly recognize we have a role to play in the transition. It's starting to understand that we see and for all of us here in CUP, it's obvious, but for us in the institutional investors, for most of us, thinking that we recognize we have a role to play in the transition, but thinking that we have to play a role for the transition in the South is a new thematic. So let's not forget that. So that's why we need to work in many directions to make sure that, it has increased. This is why we're making this, we're happy to join this agreement, and 91 and us and Natixis are happy to lead it. And I already have I think if we go forward with the project we've announced this week with Brookfield, this will be an extraordinary first case for the pilot of project preparation.
Perfect. So we get to work as soon as we leave COP. Excellent. So I'd like to now turn to Nazmira Mula, who is the Chief Sustainability Officer with 91. 91 is an asset manager based in South Africa, focused on sustainable investing. So Marc-André talked about, maybe some investors are in big countries like Brazil, India. 91, you work, Naz, in Africa. And I'd love for you to share your 2 decades of experience of trying to make finance work in Africa. And what would you tell to other investors who maybe are thinking about leaving their comfort zone? What lessons learned would you share with them?
Thank you, Alexia. Thank you, everyone, today for being here and for this great initiative. Because I think this theme that we all talk about around allocating to emerging markets is so important around achieving climate goals. And unfortunately, there's far too little that's tangible in the space. So this initiative is an actual attempt to put something on the table. So to USTDA, both Director Bong and Tom, thank you. So what have we learned? If we look at the structure of our book globally, it's about 55% in emerging markets, of which I would say a third is in Africa, but our roots are in Africa. And what we have, one of the funds we manage is an infrastructure debt fund that's been investing on the continent for 20 years. It's a developmental fund. It's one of the best examples of blended finance that exists. And the equity in the fund structure is provided by the governments of Sweden, Switzerland, Holland, and the UK. The debt is provided by a range of private sector investors in the capital structure of the fund. It's been deployed into currently about $1.5 billion deployed into 60 projects across the continent, all private sector developed projects. The fund is part of a larger group where we have access to a technical assistance facility. And over the course of the 20 years, it's drawn on that technical assistance facility a number of times. So I know the value of having easy access to a technical assistance facility firsthand through that vehicle. And it's used in various stages. It's used sometimes because someone comes to you with an interesting idea and they're so far away from actually getting to bankability that they need a bit more money to run the second set of feasibility studies. It's often used to get them over the last hurdle. And what we find particularly valuable is it's drawn on by the originator that is in charge of the transaction because they know what they need. It's not a well-meaning separate party who's structuring a transaction hoping someone will come. It's actually from the investor. And the result is that of the 90 projects this fund's invested in, it has a loss rate of 0.2% a year. If we had to map that against the Moody's default rates, what you end up with is an 8-notch upgrade between where the projects are rated because they capped at their country ceilings versus the actual experience in terms of default. So well-structured projects with people that know what's happening in country, partnering with people with in-country experience. And we support the private sector. We unbiasedly support the private sector. We find that's a much easier experience. But you then need access to things like technical assistance. So what message would I provide for investors? Start with easier things. If you haven't done emerging markets directly before, don't start with Africa unless you take some strategic decision. Not because I think I don't think it's a worthwhile space. We run a number of funds on the continent that have excellent track records. But it's Marc-André's point. You have to get teams comfortable with this. And we underestimate the psychological biases with investors. The same institutions that are uncomfortable putting private infrastructure money to work have large allocations to emerging market equities, which I would argue are much riskier. But they're comfortable with that. So that maybe I should end it there.
Thank you, Naz, and thank you for always speaking truth to power and not mincing words, because I think that's the only way you progress. And I want to come back to some of your points in a second. Thank you so much, and also your experience with the actual performance really matters, and that's the importance of better data on performance of emerging market investment, because I think, again, there's a perception of risk that's, I think, greater than the actual performance. So Amy, in her opening, talked about we don't live in a public world or in a private world, and so I'm very happy to now turn to Eric, who's with the Rockefeller Foundation, I think the second oldest foundation, I think, in the United States. And Eric, philanthropy maybe sits somewhere in between public and private, has certainly a very unique role to play, and it was wonderful to hear in New York during the UN General Assembly the announcement of $1 billion from Rockefeller Foundation for work on climate. So would love to hear more about your strategy in this space, including how it could help support this kind of a collaboration.
Sure, and thanks for having me. So you're right. At UNGA, we announced that we would commit $1 billion over 5 years to investing in climate solutions. And that commitment sort of recognizes that you don't have to make a choice between advancing climate solutions and finding opportunities for humanity. The commitment of Rockefeller for its 110 years has been to advance humanity. And so we feel like there's no way to do that without taking on the climate challenge. And frankly, we see it creeping into everything we do, whether it's nutrition and food or food security or health or energy access. Climate comes into each of those issues. If you're working on health, today you're working on climate and health. If you're working on nutrition, you're working on climate and nutrition. They're just not severable anymore. And so we've also made the commitment at that time to reach net zero emissions for our endowment, which is something completely separate but a parallel commitment. And that's something that we find very important. And we're going to bring a climate lens to each of the categories that we work on now. But you asked, what can we do to this effort? And I think it's really important to understand.
Thank you.
Look, I mean, Alexia, I've been in both government and in the private sector. And the thing that we realize is that time is prioritization, right? So Alexia's time is prioritization. Marc-André's time is prioritization. And so when you find that both the government and the private sector are focused on trying to increase investment in the developing world, and they are willing to put their time and energy into it, that means something. And from the standpoint of the Rockefeller Foundation, and frankly philanthropies at large, we feel like our contribution is catalytic capital, or what our president, Dr. Shaw, likes to say, risk capital. But we also see it as risk diplomacy. And so we've been trying to lead with our nose. And so that meant hosting the Bellagio, trying to take on this. And so, Alexia, when you asked why are we here, we're here because of the leadership of Prime Minister Mia Mottley of Barbados, and we're here because of the leadership of Secretary Yellen, because both have articulated an agenda about how we're going to recover, not just in the United States, but how is the global economy going to recover from the pandemic? And the pandemic left the developing world way behind. And that affects the global economy, and that affects American employees all across the country. And so we see it as, given that 60% of low-income countries are either in debt distress or facing debt distress, necessary for us to invest in that kind of response. And we feel like private capital mobilization is where you're going to find a real boost to the capital that's available in the developing world. And so private capital mobilization doesn't happen on a dream. It doesn't happen because we just wish it to happen. It happens because of the very practical steps of project prep, of awareness and expansion of the risk officers' understanding of the developing world. And so we feel like as a philanthropy, we can contribute to that, both focus and depth.
Thank you so much, Eric. And your description of how climate is sort of permeating all areas that Rockefeller Foundation works in really resonates. And I think that's why the urgency of being able to mobilize more financing for the breadth of climate development growth needs of countries really make sense. And great to see Health Day at this COP. So that was that. Thank you for those points. So I'd like to follow up with a few more questions for our investor panelists. And the first one is the following, and maybe we'll start with you again, Marc-André. So with the partnership of today, we should have some investment-ready, attractive, good projects coming out of the pipeline. That's really important because we know it's an obstacle. But to practically see CDPQ investing in these projects, what else do you need so that we, when we come back in a year, are really seeing new projects have been funded?
Well, I think what is needed, so we've often said what is needed is project preparation. It's the first loss facilities, call it catalytic financing, or well, I'll come back to that. The foreign exchange risk at scale, and then we've been asking the MDBs to share, because the MDBs have an experience that we don't have in emerging markets, and it would be so valuable. You know, the GEMS database and the access to it would be so valuable for institutional investors and including banks. To actually be able to assess and price it appropriately, and it would certainly lower the cost of capital in those countries if the GEMS database was public or widely available. So, just to give you an example, I give that often, but like we started investing in emerging markets in the last 7 years. As I said, we have $60 billion Canadian. Each and every year, our returns are eaten up 25%. In the last 5 years, 25% of our returns have been eaten up by just the foreign exchange risk. And so it is a real issue. We report our results twice a year in Canadian dollars. So this is an important thing for us. Then just finish on the catalytic funding. I've talked about the Brookfield Lunete opportunity. This is interesting. Lunete, which is a kind of an affiliate or something that is in line with ADQ here, which is one of these sovereign wealth fund of the UAEs. They've agreed to do. They said we won't go for first loss, but we'll go for kind of capping our return. So they're accepting to cap their return to subsidize in a way the returns of the other limited partners that will come into the fund, like us and Temasek and others. And so that's a way of de-risking as well. And then to the people who listen to us who are in multilateral development banks or in multilateral organizations like the UN and others, often say that, just think about the UN, there's a lot of information that institution has, and they have country teams in more than 100 countries, where actually, in many cases, it would be key to actually help us with the knowledge, connect us with the right people on the ground, and make sure also that we need capital markets in those markets. And so far, development has never focused on that. But it's very important that we work on all of this together. So this is a longer-term game, but I know your question was more short-term, but I think we need to look at it. We need to work on all legs of the stool at the same time to make sure that, making sure that the culture in my institution gets more focus on this, that we see it more as an opportunity, less as a risk, that we develop and get to know the right partners, but we also need to work on the development of partners, and we need to work on the development of the tools that are needed, which are the foreign exchange risk, the first loss facilities, and obviously the project preparation is a big thing. And also, let's not forget, for governments who are listening to us, who are thinking, we think there's less risk. We're the largest institutional investor in the world. We think there's less risk in buying brown assets that already exist. So MDBs and national governments, when there's assets to sell that they want to monetize, we are obvious candidates. And for us, as a first step, it's often easier than going and start to build something green. We're going to come, and to really finish, On the greenfield projects, we have portfolio companies in our group, so that will actually be the real clients for USTDA, who are in the field and actually are the ones developing the projects. Rather, it's rarely the institution like mine. It's through our portfolio companies and our partners.
No, thanks for that. I think your point on brown projects is important, particularly in the context of the just energy transition, the importance of being able to either decommission coal or to have coal flex. I think having investors willing to come in is really critical. You've put a lot on the table already in terms of foreign exchange risk, first loss, de-risking, also knowledge and information on these markets. Naz, what would you add in terms of what else you need? You get projects coming out of TDA. What else do you need to sort of be able to invest? Naz?
I'll just say, Alexia, on what
Mark.
one second, just for clarity. As what I meant as brown projects, yes, it's a project you've talked about, but in infrastructure, it's also a term for existing infrastructure. So I just want to make sure that it's both, but it's also...
Okay, go. So brownfield infrastructure projects and the ability to do. Thank you. Good clarification. Thank you for that. Naz, what would you add?
I think Marc-André's listed the major aspects that I think investors want to see. I think some of the nuances to think about is, in general, debt tends to be hard currency denominated. It goes back to the fact the average institutional investor is happy to do equity and take the currency risk, but they're not comfortable doing debt. So it's these silos. I'm an economist by training, and as I get older and grayer, I increasingly focus on behavioral economics, because I think when I was younger, I underestimated how much our biases influenced outcomes. It's like, of course that you know that you're not going to do that, and this whole discussion we're having is fraught with the behavioral biases. And so when we think about how we overcome that, the best way is experience. So in order to do that, we need projects well structured. We do need some sort of risk mitigation as a start. And that can come from, supporting the returns or limiting the downside, but that would be very catalytic. And I'd be hopeful that certainly in middle income markets, it's not needed on an ongoing basis, because it closes that gap between perceived and realized risks. So I think those would be the things I'd focus on, is getting investors in and therefore that sort of catalytic capital being more available is super valuable.
No, thank you. So I think we have a good work program coming out of what both Marc-André and Naz said. And the good news is there's a lot of work happening on everything that you've mentioned, whether it's on foreign exchange. I think the TCX is here. They're a group that does a lot of work in terms of providing hedging for lots of currencies in emerging markets. I think the multilateral development banks have heard the call from the investors and are really doubling down work on trying to expand the suite of instruments that can help bridge the gap, including work on guarantees, work on an originate to distribute model where they share assets with the private sector. EBR and IDB is doing that. EBRD looking at risk participation in insurance for insurance products and investors. So much more to do, but I think there's a momentum that has started. Local capital markets development, I think a critical agenda that many institutions are also definitely focusing on. And glad you mentioned the country information piece and the policy. We haven't just talked about policy, but a lot of times when we talk in quiet conversations, policy certainty and reputational risk, actually you often mention. So the country risk almost being more important than the project risk. And those are issues that we need the development banks to work on. So my last question will be around what you termed, Naz, the psychological biases. You are champions, Naz, Marc-André. My sense is that we need to multiply the number of champions in your organizations and in other organizations. What are your ideas for how to do that? What are your ideas for this mindset shift that you mentioned, Marc-André? What are your ideas for addressing the psychological bias? And maybe I'll start with Naz here.
Difficult question comes to the woman first.
I agree.
Experience is the best one. Experience is the best one. So let's start with smaller investments, but that will force people to interact with the data set, will actually result in the experience. The reason that virtually every large developed market asset owner is very comfortable with emerging market equities in their portfolios, despite the 25% a year haircut on foreign exchange in the last couple of years, is because they've got 25 years of experience. And they know the dollar doesn't appreciate forever. And at some stage, you will be facing the opposite problem, one hopes, in our lifetimes. So I think experience is the best way to overcome it, because otherwise it's theory. It's a conversation that doesn't overcome the bias.
I think it's experience, but I would put it in a wider sense. I think I like working on all legs of the stool, because we need experience, but we need knowledge. I mean, like, let's face it, institutional investors have very little knowledge outside of the OECD markets, and so we need knowledge, and we need to make sure that I don't come from the investment world. I've been in this only for now close to 4 years, but I was in diplomacy before, and before that I was in law. It's exactly the same thing. It's all about relationship. It's way more emotional in investment than I thought it was, and to assess the risk. So let's make sure that people are aware of the opportunities, and it's not by. Remember that investment is bottom up. And so we need to make sure that at CDPQ, we make the young investors, the young analysts and directors who are looking at these markets and these thematics comfortable with it. So that's why inside CDPQ, I feel I'm responsible for the global operation. I feel now an obligation to actually create some programs to make sure that our people are more aware of what's happening in the world, of the growth in Africa, of the mega cities that are being built, of what's happening really in this region. We've invested in this region in a very significant infrastructure 2 years ago in Jebel Ali with DP World, our partner with whom we own 9 other ports around the world. It has changed our view of what's happening in the region, because we are here, we understand, and our people understand what's happening and how the trade flow is going. You live it. It's one thing to read it on your screen through Bloomberg. It's another thing to have it in your portfolio and face it. So it's all about that.
That's wonderful. If I were to summarize what I just heard, I would say, number 1, exposure, exposure, exposure. And number 2, just start, just do it. And I think it's important to sort of break down the ability to start to a small piece. Otherwise, it's sort of overwhelming. So that's just been fantastic. You had a comment you wanted to add to close us out?
Yeah, I just wanted to point out that when we saw the African Climate Summit, we saw President Ruto of Kenya really return to a much, much higher level of emphasis and focus on the investment case for Africa, not just sort of what's gone wrong and why it needs to be fixed, but really what is the proactive reason that investors from all around the world should want to invest. And there's a very strong case, and instead of focusing on what needs to be fixed or what's wrong, he's really made the proactive investment case for coming to Africa.
Actually, I'm gonna stop us now, because I think, Eric, you actually ended us beautifully, because I think if anyone has doubts, listening to President Ruto, I think is quite compelling. So I'm glad that you put this on the table. And then he is so compelling that you don't want to miss the first mover advantage and get started right now to take advantage. So with that, thank you to this wonderful panel. Thank you very much. A panel, first a round of applause for the panel. Oh, sorry. Okay, and now we're going to transition to the signing ceremony. So I'm going to ask everyone to stand up. Our colleagues, our fabulous colleagues from the UN Center, will transform the stage in a few seconds. And while they transform the stage, I'd like to remind us all what Enno started us off with, which is the purpose of this signing that's about to happen and this strategic partnership. So this strategic partnership gets to the heart of one of the most stubborn obstacles to mobilizing private finance in emerging markets, and that's the lack of well-prepared, attractive, bankable projects. And the benefits of this partnership is a win-win-win, I believe. I think there's a win for you, NO, and for TDA, because TDA will be able to know that there's real private money. When the projects come out that are prepared, they will get financed, because you just don't want to prepare projects that go nowhere. I think there's a real win also for ILN members and for Marc-André and for NAS, because they will be getting projects that are well prepared with all the legal work done, the environmental and social and governance safeguards work done, engineering work done, the strong relationships with the government.
In the end, the beneficiaries of all of this are the people. This is all about people. You don't often think that in infrastructure, but it is. And those communities will absolutely thrive and see economic growth if we can find our way to making these projects implementable and financed as well. If I may, as we move to signing, I do just want to give the vote of thanks on behalf of all of us who sat up here on stage to the people who weren't on stage who made this happen. And so from the Treasury team, Lyda Fitz and Lorraine, from the USTDA team, Tom Hardy and Sarah Witten, from the Rockefeller Foundation team, who's not with us, Lily Hahn, and from your team at ILN, Christina Rees and Emma Dreiss. Just thank you to all of you, because we wouldn't be here without you.
Absolutely. A round of applause for that. All right, so I think if I can invite everyone back on the stage for this win-win-win with the people of emerging markets as the first winners. Marc-André, Naz, Eric, we're going to stand behind and observe the signing. Thank you, everyone. See you next year for the results.